Welcome to another In Conversation. My name's Duncan Niven. I'm the Director, Head of Research here at Pitcher Partners Investment Services. Joining us today is Peter Berezin. Peter is the Chief Global Strategist for BCA Research. BCA is one of the leading global providers of independent financial market and economic research. Its research plays a very valuable part in the way that we think about asset allocation and ultimately how we help construct your portfolios. Peter is here today to help share the key issues that are front of mind for him. Many thanks, Peter, for joining us. I know it's very late where you are, so we really appreciate you taking the time to chat to us today. First, perhaps if we could just start with the bond market, obviously the pickup in long-term bond yields that's been occurring. Could you just tell us what are sort of the key factors that should be informing us about, and how does that feed into your view of potential US recession being into next year?
Yeah, I mean, it's interesting to look at the causes for the rise in bond yields. It's probably better to start with what hasn't caused yields to go up. It hasn't really been a story about rising inflation expectations. If you look at market-based inflation expectations, look at survey-based inflation expectations, they haven't really budged very much. They've actually been remarkably stable over the course of the pandemic, even during the time when inflation was rising sharply. Nor has the increase in bond yields really been a story about the market pricing in a higher terminal rate or a peak funds rate. That hasn't changed very much either. Rather, what's kind of driven yields higher is this whole higher for longer narrative, the idea that the Fed will just keep rates higher than what was previously anticipated, not just for the next couple of years, but really over a longer term horizon. So the way I interpret this is that the market is saying that this equilibrium or neutral rate of interest is higher than what they once anticipated. That's something that we've been talking about for a long time. You know, prior to the increase in yields, we talked about how bond yields really ought to be much higher than they were, because the forces that necessitated lower yields following the financial crisis, very high unemployment, this very painful deleveraging cycle, that had really kind of gone away by the time of the pandemic. And so the need for those low rates just wasn't there. And the market, after a while, was sort of tuned in. But at this point, you could argue that bond yields have probably gone up too much. So we've changed our view. A month ago, if you asked me what my view on bond yields were, I would say probably they're going to go higher. But at this point, I think they've gone high enough, and the next leg in yields will probably be to the downside.
Moving to the tragic events that have been occurring in the Middle East, and we obviously don't want to downplay any of the catastrophic events that have been occurring there. However, could you please share just some of your thoughts from an investment perspective, near and potentially longer term?
Beyond the human factors, which many ways take precedence over the economic factors, from an economic perspective, which I can talk to, the big risk just surrounds around the path of oil prices. So globally, supply conditions are quite tight already, and introducing these additional geopolitical risks into the equation could potentially set the stage for a further increase in oil prices, not just because some of the oil that Iran has been producing and illicitly selling into the global market, if there's a broader conflict, some of that oil could go offline. But even the situation in Russia that hasn't come anywhere close to being resolved, and there's certainly a chance that Vladimir Putin will take some oil off the market next year, maybe drive up oil prices, drive up gas prices, and make life a little bit more difficult for Joe Biden, because there's little doubt as to who he would prefer to win the election. I'm sure he'd prefer Trump over Biden. So I think the risks to oil prices are to the upside. over the next 6 to 9 months. Now, eventually, when we have a recession, and we do think that a recession probably will start in the second half of next year, at that point, the risk to oil prices is going to be to the downside. But until then, an oil shock is something that we have to really kind of focus on from an economic perspective.
Moving on to China, obviously a key factor for our local economy and markets here. You kind of mentioned in some recent strategy pieces that investors may be sort of misdiagnosing some of the key risks there. Could you just unpack that a little bit more, and then perhaps, if possible, just dovetail some of your broader views around the rest of Asia and emerging markets?
I mean, in many respects, China's economy faces the same sort of problems that Japan faced in the early 1990s. Of course, back then, Japan began to experience a very deep, painful, prolonged housing bust. China could very well experience such a bust, if not worse. In fact, in many dimensions, China's housing market looks more unbalanced than Japan's housing market looked like in the early 1990s. More leverage, more oversupply. I mean, there's some studies out there looking at the amount of light emitted from Chinese homes, suggesting that maybe 10% of the housing stock is completely vacant. For point of reference, in the US, it's like less than 1%. So you've got massive oversupply, you've got massive over leverage. You've got prices that, relative to rents and incomes, are kind of as high as in any major city in the world. And then on top of all that, the demand picture is just going to go from bad to worse. If you look at the latest projections from the United Nations, the UN estimates that China's working age population, the number of people between the ages of 15 and 60 or so, that will shrink by 60% over the remainder of the century. So that is a recipe for much lower home prices, much lower home construction. So the question is, like, what does the government do about it? Well, in some sense, if the problem is too little spending because people aren't buying homes, that shouldn't be a problem that is insolvable. I mean, raising demand shouldn't be difficult. Raising supply is hard, but getting people to spend more shouldn't be hard because people like to spend. But in practice, as the experience of Japan shows, it's difficult to do. And in China's case, it's particularly difficult to stimulate the economy sufficiently because most of the spending is done by local governments, and they're strapped for cash. They don't have the ability to sell land and raise revenue because the real estate market has basically frozen up. And at the same time, they've issued a lot of debt through these local government financing vehicles, and there's not much appetite for buyers to purchase more of this local government debt. So I think the risk of Japanification is very significant. Now, right now, that's not a huge problem for the rest of the world because the rest of the world has pretty tight labor markets, and if anything, inflation's too high in the rest of the world. So if China's exporting deflation, it's not necessarily that bad. But certainly over the next 12 to 18 months, if inflation in the developed world kind of goes away and rising unemployment becomes the major problem, if at that point China's still exporting deflation, that would exacerbate the global downturn. So I think there's a lot of risks around China, and certainly in the EM world, there are a lot of risks to countries that produce commodities and sell those commodities to China. So Latin American economies, I think, are potentially vulnerable. But then on the flip side, there are also economies that could potentially benefit from the geopolitical changes underway. Increasingly, a lot of foreign investors are looking for other economies to invest in rather than China. So that could potentially be beneficial to countries such as Vietnam, Thailand, the Philippines, just to name a few.
If we then look at Europe, what are your thoughts there? Particularly, you mentioned recently about potential consumer manufacturing. Any kind of green shoots there, or What's also the view heading again into 2024?
If you look at countries like Germany, like they've gotten really badly hit by the manufacturing downturn that's been ongoing now for uh, over 18 months. Now, that downturn largely reflects the fact that people splurged on manufactured goods during the pandemic. And then when the pandemic ended, they stopped buying as many goods and bought more services, and that hurt Germany and other major manufacturing exporters. If you look at spending on goods versus services, it's sort of been stable now for about 10 months or so in the US. If you look at inventory levels globally of manufactured goods, they've really come down. So you can make a case, it's still kind of a tentative case, but you could make a case that we might see some pickup in manufacturing activity. Certainly, if you look at, say, Korean exports, they're kind of a good leading indicator for manufacturing activity. They have picked up. So that is kind of encouraging. If that happens, that will definitely help Germany and other manufacturing intensive economies in Europe. The other thing that could potentially be quite important is that inflation in Europe is really coming down now. It rose a lot. In fact, it rose more in Europe than it did in the US, because in Europe you have the additional issue around surging energy prices following Russia's cutoff of natural gas exports to Europe. But that problem has really abated, hasn't gone away, but it has abated. And now, as inflation is coming down in Europe, real incomes are rising. And typically what happens is that when real incomes recover, you get more spending. In Europe, there's a lot of pandemic savings, probably more so now than in the US. European households didn't spend their savings as rapidly as American households did. And there's a lot of pent-up demand. If you look at spending on consumer durable goods in Europe in real terms, it's about as high now as it was in 2019. So there really hasn't been any growth in consumer durable spending in about 4 years. So there's a lot of pent-up demand. So I wouldn't be surprised if European growth surprises on the upside over the next 6 to 9 months, but it probably will be fleeting because the ECB has raised rates quite a bit, and the lagged effects of those rate hikes will work their way through bank lending over the course of the next 12 to 18 months. And probably, just like in the US, Europe's economy will eventually succumb to recession in the second half of next year.
So we take all of this into account. What are your thoughts from an asset allocation perspective for the next 6 to 12 months?
Well, I think for bonds, it's kind of an easy call at this point. Yields have increased a lot. I think they've overshot fair value, as evidenced by the fact that job openings are declining. So that's kind of telling you that monetary policy is tight. Now, it might take a while to eliminate enough of those job openings to get to the point where someone loses their job. They can't just walk across the street and find a new job. So I can see a scenario for the next quarter or two where we continue to have disinflation, but it's fairly benign because people who lose their jobs are still able to find new ones. But probably as we get into the second half of next year, as I said, at that point, you get a recession. So initially you get falling bond yields because of lower inflation, then you get falling bond yields because of recession. But either way, it's kind of a bullish backdrop for bonds. For stocks, it's a tougher call. And typically, stocks peak about 6 months before the onset of a recession. If the recession starts in the second half of next year, it might be still too early to get underweight equities, at least if you're kind of tactical. If you're not tactical, if you're not very nimble, then I certainly wouldn't fault anyone from paring back exposure to equities now. So to answer your question, tactically, our 3-month recommendation is to be overweight equities, but our 12-month recommendation, which I think is actually the more important one for most investors, it's to be underweight equities and to be significantly overweight bonds. In other words, we are kind of moving towards that bearish camp. Started off this year very, very bullish on stocks, but then we sort of tempered our enthusiasm mid-year, and now increasingly are getting a little bit more defensive in anticipation of this recession that we expect in the second half of next year.
Peter, That's fantastic. Thank you very much for taking the time and sharing your views with us, and have a great night. Thank you.
Thank you very much. I really enjoyed this conversation.
Thank you for joining us today. I hope that you took a lot out from this session and with Peter's insightful comments. If you'd like to learn more, please reach out to your local Pitcher Partners advisor. You can search our website or check out our YouTube channel or our LinkedIn page. Thank you and have a great day.